Okay, so hopefully you all know what you signed up for today. We're going to be talking about how to account for your new property acquisition. A little bit about me. My name is Alex Frazier. I'm a CPA. Just like you guys are all over the place, I'm located in Springfield, Missouri. That's in the very bottom left corner of Missouri. I'm an accounting manager here at Hall CPA. I oversee the CFO Services Division. I've been with Hall in this role for about 3 years. I've had 8 years in client advisory roles doing exactly what I do now. And I do have a background in accounting, tax, assurance services. I came from a small firm, so we got exposure to everything where I came from. You're all here because you wanted to hear from Hall CPA, but I'm going to talk real quick about what Hall CPA is, who we are, what we do. We are a fully digital firm. We don't have a physical office anywhere in the country. The closest thing that we have is Brandon Hall's kitchen table, which nobody uses as an office. With that in mind, we're able to look across the country, get the best talent from everywhere that there is in the United States, and that allows us to specialize in real estate. There may only be a handful of real estate specials in Raleigh, North Carolina, but when we look across the entire country, there's a lot of us, and we work very hard to bring those people together, the accountants that specialize in real estate, and we bring them together into one place so that we can have a really stellar team. With that, we also look to the future. We want to see how do we future-proof our business against the changes that are coming up in the world, whether that's from tax preparation side or the bookkeeping side. We want to make sure that we are having a relationship with you all, the clients, so that we can build that trust and that you guys want to continue working with us year after year. With that in mind, today we're going to be talking specifically about accounting. And even more specifically, we're going to be talking about what do we do when something changes with your assets. So let's dive right into that. This is going to be a very in-depth conversation, but I'm going to try not to dive into the weeds on every single possible situation you could have on every single statements. But with that in mind, it is still going to be comprehensive and in-depth. So I'd recommend that you take a second, grab a notepad and a piece of a pen, and that way you can take notes as we go. So what are we talking about today? We're going to talk about the proper accounting for your new real estate acquisition. So you've just purchased an asset. How do we get it into your books? Additionally, we're going to talk about how to record the results of a cost segregation study. And then from there, we're going to talk about, down the road, you've had this asset for a while. How do we record a refinance once you get to that point? So with that in mind, what do we need to get started? The first thing that you're going to need, and this is very important for this conversation, you're going to need a comprehensive accounting system. That could be QuickBooks, that could be Appfolio, that could be Buildium. Those are the ones that I've called out here. There are a ton of other ones that we could use. The most important part here is that we want to make sure that they do double entry accounting. So we have a debit and a credit. That's very important. And then we also want to make sure that they have a balance sheet. There are some financial systems, believe it or not, that will only give you your income statement. They won't have a balance sheet. In those situations, what we're going to do today is not super efficient. It's not going to be a great use of your time. If you are working in one of those systems, maybe even spreadsheets, I encourage you to get in touch with Hall CPA after this call, and we can help you get set up with a comprehensive accounting system. Okay, so what else do we need? We're going to need closing statements, and we're going to need some tax assessor data. Now, the reason that I mentioned that is the tax assessor is going to be a great place to get the land value. Ultimately, you may have had an appraisal done at the time that you got your property, and sometimes the appraisal will break out the difference between, okay, well, this is the value of the land, and this is the value of the improvements on that land, improvements being, buildings, sidewalks, all of that stuff. So if your appraisal has that broken out, that is going to be a higher quality of information than what we're going to get from the assessor's office. So definitely default to that. All right, with that out of the way, let's jump right in. So getting started, what I've got pulled up here on the right-hand side of the screen, this is a closing statement that if you've purchased an asset, you're probably very familiar with. There are a bunch of different formats that these closing statements can come in. What I've got here is a HUD statement. U.S. Department of Housing and Urban Development. This is kind of their standard format, and it's what we're going to work with because it's probably the most common. But sometimes different closing companies will have a different statement, being a little bit different format. It's all going to contain the same information. So as we pull up this closing statement, we're going to look at it. We're going to say what's important. Well, of course, all of it is important. As we look here, we want to have a look at what's in the header information. We want to make sure that everything from you is correct. Your entity name and so on and so forth. We want to make sure that the property location is correct. The settlement statement date is cut off on the right hand side here. We want to make sure all that's correct. But if you're getting to the point where you're ready to record it in your accounting software, you've probably already given up your money, you've signed on the dotted line. A little bit too late to start making changes on that. But hopefully we reviewed it at the time that you acquired the asset at the time of closing. So what is really important for our purposes? The way I like to do this is I'll start at the top of the statement and then I'll just work my way down. And we want to be here in this left-hand column. This is going to be us, gross amount due from borrower. And we're just going to go through the whole process from top to bottom, and we're going to record everything on this statement. So what we do is first I'm going to come in here. I'm going to look at the contract sales price. That's, I've got some nice round numbers in here to make our calculations easy. We're looking at $1 million for our purchase price. Okay. That's the listing price. That's what we agreed to. That's what we said we'd pay. And then from there, we've got these settlement charges. For right now, I'm going to skip over these because they're going to be in the next section. We're going to talk about those in more detail because it's more than just saying, okay, settlement charges, great, that's one line. It's going to be more nuanced than that. So all of these things add up, gross amount due from borrower, $1,050,000. And then we go in a little bit further, our earnest money deposit, that's going to be, refunded to us because we paid it in advance and now it's coming back through closing. We've got our new loan that we took out on this property. We got $800,000 of financing on this property. Great, we've got that allocated. We're buying here on January 25th is the date of this statement. So we're going to have prorated rents that come in. We're going to show, okay, well here's what it looks like for the portion of the month that is remaining, and it's showing $9,000 is what would have been due here for the period of time that we own this asset. And then additionally, we've got some county taxes. We're going to have to pay the full amount of the taxes at the end of the year. So we're getting a little bit of a credit on the front end for the time that the previous owner owned this property. So that's what's going on there. And then the very bottom line here, $230,000. That's the amount of cash we had to come to the table with at the time of closing. So with all of that, these are the important parts. Again, we're just starting at the top. We're going to work our way all the way down to the bottom. So let's get started with the journal entry. In all of the accounting softwares that we have, there's going to be some way to put in a journal entry. Some softwares, it's not called a journal entry. Maybe it's just a different way of, recording an expense that's coming through the bank. We can do this in a variety of different ways, but again, all the softwares are going to come back to a similar approach here. So what do we do? Again, I called out the building, the EMD, the mortgage, the rental revenue, the property taxes on that previous slide. And so here we were, again, all of those with the amounts. So I'm just going down again from top to bottom, purchase price, earnest money, financing, rents, and taxes, and then cash. And that's what I've got called out here as well. So I'm very strict on this point, not strict, but for me, I'm strict on myself. I always like to go top to bottom. There's a couple reasons for this. The first reason is it just helps me keep it straight in my brain as I'm going through and saying, okay, well, this line matches, this line it matches. But then additionally, whenever I come back to this journal entry in the future and I've got my support pulled up next to it, I'm not having to ask myself, well, where did this number come from? Where did that number come from? It's very easy to see, okay, well, this one lines up with the top, and we just go down line by line, and it all lines up, and it makes your life a lot easier in the future. I would encourage you to take that approach. If you don't, I think you're going to find the same thing is true whenever you go to review your transactions in the future. Anyway, with that in mind, okay, so we've got all of our accounts are in here. Let's start putting the numbers in. So again, these are the same numbers that came off of that statement. And just talking here about the debits and credits. let's talk about why it's a debit versus why it's a credit. With the building, this is the asset that we're getting control of. Okay, so this is increasing the cost of our assets. This is a debit here in the journal entry. It's going to increase the value of our portfolio by $1 million. The earnest money deposit, that is money that's coming back to us, but it's a reduction in the amount that we have to pay because we've already paid that $10,000, so we don't have to pay it again. The mortgages, again, that is a reduction in the amount that we have to pay. $800,000 is being paid by the bank. Rental revenue, the seller is not going to give us $9,000, but essentially what they're doing is they're reducing the sales price of our property by $9,000 to show us that, we're getting the benefit of that money that they already collected. So what we do is we're going to record this to the rental revenue line on the profit and loss on the income statement. And that's going to be our first month's revenue that we get on this new asset. Similarly, with the property taxes, this is an income, but it is reduction of an expense. So we're going to show that as a credit as well, because again, it's reducing the amount that we have to pay. And then approaching this one a little bit differently, this cash here is what we're having to bring to the table. So it is the remainder of what has to be paid. So when we're done, our debits and credits don't balance currently because we skipped that $50,000 of closing costs, which we're going to put on here in a minute. But when we're done, this bottom line should balance on both sides, $1,050,000 on both sides of the transaction. All right, so now we're going to move on to page 2 of our HUD statement. And we're going to go down the list again, top to bottom, what's important here. So we're going to start here at the top, and we're going to say, okay, what's the total of our closing costs? This $10,000 here, this is a commission paid, and it's going to be the first part of our closing costs. So I put that here on the closing costs. And then we go to the next section. I recognize that's 30,000 and this is 10, but we'll get to that here in a second. The next section here is the loan costs, items payable in connection with the loan. This closing company did a really great job of grouping everything together for us in the different places where we're going to need to record them. Sometimes we will see a closing statement that, they've got title costs and they've got surveys and this and that, and it's all mixed in with the costs that are payable to the lender. In those situations, we have to use our best judgment and we have to go through and allocate and say, okay, well, this is something that's directly attributable to the loan. This is something that's more attributable to getting the property, making sure that it's safe, all those things. Loan costs are going to be recorded separately from closing costs because they have a different depreciable life when it comes to our financials, when it comes to the tax return. Basically, those loan costs get depreciated over the life of the loan. So if you've got a 5-year loan, those costs are going to be spread over 5 years. If you got a 15-year loan, same thing. And then the closing costs are just going to get rolled into the value of the building, and then they'll be allocated with a cost segregation study down the road to say, okay, well, this is the asset life of these closing costs. So that's the difference there. Again, the closing company did a great job of allocating this for us. All of these amounts here, items payable in connection with the loan, totaled up to $10,000. Again, all these numbers are made up by me, so they're nice round numbers. In real life application, we're probably not going to see something so clean and easy to work with. Okay, so loan costs, and then we're going to come down to the items required by lender to be paid in advance. In this situation, we've got some interest. It's calculated based on the number of days that need to be paid in advance. Oftentimes, the lenders will say, okay, you've got your loan now. Your first payment isn't going to be due until such and such date. Let's get all of the interest paid up front for that time period, and then we'll resume regular payments afterwards. So that's what's going on here. We've got interest coming in. This is going to be recorded as interest expense. This is not a cost that gets capitalized to the balance sheet. We get to expense this in the first year of our asset, assuming that it's going to be placed in service as soon as we purchase. But again, this goes directly on the income statement. It's an expense. It goes directly to the bottom line. It works great for us. And then again, we've got hazard insurance. So I've called it property insurance here because that's the way it's going to show up in the books. Now this one is a little bit of a different conversation. I'm going to throw some nuance in here. If you've got the cash basis of accounting, this is going to go directly to your income statement. You're paying your property taxes at the time that you closed. We're going to put it on the income statement. If you've got the accrual basis of accounting, we're going to put this to prepaid insurance. If this is a 12-month policy, we're going to take a twelfth of this $5,000 and we're going to roll it off every single month. And we're going to have a smaller amount of insurance that shows up on the books every month. So it's going to be important here at this junction that you understand for your books, are you cash basis or are we accrual basis? And that's going to determine where this one goes. My assumption here is that most of us on this call are more than likely cash basis. So I've put this to property insurance expense, and that's where it's going to show up on the income statement. Okay, so great. What's the next step then? We've got all of these. We started at the top, we're moving to the bottom. We get down here. These are the other expenses. So we had this $10,000, and then we've got these title charges. And if you go through and add these up, there's another $20,000 here. So 10,000 and 20,000. That's where our $30,000 comes from. So the next step is we go back to our accounting system, and we're going to put in these transactions at the bottom of that journal entry. So again, we had the building cost, the earnest money, the mortgages, the rental revenue, property taxes, and the cash. That all came from the front page of the closing statement. And then we get down here to the second page. We're going to record the closing costs, the loan cost, that $10,000, the interest paid, and then the property insurance expense. Again, if you're accrual basis, that would be recorded somewhere else. And that's, again, just directly in the same order that they came off of page 2. We're putting them onto the journal entry in the same order. Okay, so next, let's talk about how do we get our land value. So this is important to us because we know that land is not depreciable. Our building, we are going to depreciate. That's going to be depreciated over 27 and a half years if it's a residential unit, 39 years if it's a commercial unit, and that's going to be depreciated. But in that $1 million there, a component of that is the land. What happens if some really strong wind comes through and blows the property clean off of the land? Well, it's still there. You still have an asset, and it's not going to ever depreciate for you. It's going to stay there. So we have to be able to call that out separately. And as I mentioned earlier, there are 2 ways to do this. One would be if it's on your appraisal, definitely use that number. That's going to be the highest quality of data support, of cost support that you can present to the IRS or to any third-party user that's going to be using these financials. Sometimes the appraisal doesn't break out the land separately. So in those situations, and I think probably more commonly, what we have to do is we have to find a way of saying, okay, well, we have a third-party support for the number that we used, and it's a government agency, so we know that they're not trying to help us look any better than we would otherwise. They just want to be able to collect their taxes. So in that manner, we can rely on this data pretty well. So what we can do is we can go out to the county assessor's website. Will typically have public information that says here's their valuation of a property. If it's not available, then oftentimes you can go to another website such as Redfin or Zillow, wherever you would review your property sales listings. And they will oftentimes, if you scroll down, they'll give you the tax history for this asset. So you can see right here, we could have gone to the county assessor to get this information. This information came from Redfin. They go out and they collect that information from the county assessor for us, and then they post it directly on the website so you can see it on the listing. So what we've got here is we've got the county assessor says, here's the amount of land. Here's the amount of additions. Again, we called that, the building, the sidewalk improvements, any of the utilities that had to be added, all of that is included in the additions. So the assessed value per the county assessor is $260,000. And of that, they say $93,000 is the land allocation. So if we take that, we take the land, we divide it by the total, that tells us 36.2% is the land valuation of this property. So again, we're getting into the weeds. If this isn't something you've worked with before, I would encourage you to jot down the notes there in the notebook that I recommended earlier. And this is going to be how we get to that allocation. Okay. And now we're going to take that contract cost. We've got the $1 million that was on the front page, the page one of our closing statement. We're going to take that and we're going to allocate the 36% from this equation here. And that's going to tell us that of the $1 million, roughly a third of it, $360,000, is what we need to allocate to the land. So we've got this journal entry, which is where we were before. No land included, $1 million here on the building. I'm pointing with my finger instead of my mouse. We've got the building, $1 million. Did this allocation, and then we're going to add in a line where we have the land. So what I've done is I've just taken that $360,000 from our calculation. I've subtracted that from the building, and I put it on its own separate line. Okay. Now, with that, our asset is recorded. We just have to hit save. This journal entry is saved, and we're ready to move on. A little bit of housekeeping. If your software allows you to attach a document directly to the transaction you're making, I always encourage that you do that. In this situation, I would put the closing statement on there. If you've got a promissory note, I would probably include the promissory note or any sort of documentation from the lender. And then I would also include, this screenshot that I've got here in the background that shows where my data came from for my land allocation. All three of those things, those documents, are going to be very helpful to you in the future if you ever come back to this and you have to answer, okay, one, where did all these numbers come from? That's a closing statement. Two, where did my land allocation come from? That's your asset, the SNP that you did from the assessor's office. And then additionally, if I ever come back and I want to verify that my mortgage was truly $800,000 at the time that I recorded this transaction, that promissory note documentation or the mortgage documentation is going to be crucial to have at that time. So coming back to this and having it just available is going to save you a lot of time. If your software does not allow you to attach documents, make sure that you've got it stored, whether that's digitally or in a filing cabinet. Make sure you've got it stored in a way that's going to be easy to get to. Have a folder that says, closing statements, and in that, make sure that you've got your assessment data, your closing statement, and then your document from the lending. All right. So that was it with recording the initial asset. Hopefully that is super helpful to you. And we can come back to that. I've got a Q&A at the end. If you have any questions about, anything specific, we'll come back and talk about that. So I want to move into part two, recording the results of a cost segregation study. Before we start, getting into the meat and potatoes of this, I want to talk about a couple of key topics to make sure we're all on the same page as we proceed. Okay, so what is a cost segregation study? As we went through the last journal entry here, we've got buildings and we've got land. That's easy for us to allocate out. We can make that adjustment pretty simply. But what we have here is we've got this this asset, and maybe it's more than just the building that we want to break out. Maybe we want to break out some improvements. Maybe we want to break out some equipment or some fixtures that came with it. That's not something that we can do just willy-nilly. So we want to bring in a professional. We get a cost segregation study. You can do these as a DIY online, or you can go out and you can have a professional come out and take pictures of your property and do a full-scale study. And what they're going to do is they're going to go through all of the assets, and they're going to say, okay, well, this portion is going to be a 15-year asset. Maybe that's a land improvement. Sidewalks would fit into that. Parking lots would fit into that 15-year assets. Maybe it's a piece of equipment. Refrigerators fall into that. Maybe you got your appliances, your dishwashers. All of that came with the unit that you bought. Those would be 5-year assets. So the reason that that's important is when we start depreciating these assets, they're going to depreciate at different speeds. You want as much as possible to be a 5-year asset from a tax perspective, because that's going to drive a bigger loss in the first year. You're going to have more of your cost that's allocated to that 5 years versus the 27.5 years of a residential property. So that's what is a cost segregation study. Why is it important? Again, it drives that depreciation. And then how do we record the transaction? Before I do that, I got a question in the chat. What if you bought the property with cash? So if you bought the property with cash, what it's going to show, again, slight detour here. Come back here to, oh, sorry, I went the wrong direction. One moment. Come back here to page one. Instead of having the principal amount here of $800,000, the cash from borrower down here is going to be increased. So this would be 1,030,000 if we had to include that 800,000. So with that, that's going to be how to record the purchase specifically. Now, if you put the funds into the property without putting them into your entity, um, then we'd have to start talking about, is that a cash contribution? Is it a loan from you personally? What does that look like? In most situations, I would recommend that the cash be in the entity and then the entire amount go to the closing company in advance. And it just makes the accounting cleaner that way. Sherry, if you've got specific questions, I'm going to have my email at the end. Feel free to reach out to me directly. I'll be happy to talk with you in more detail about that. All right. So let's go back to our cost segregation study here. All right. So this is the cost segregation study. This, again, I've made up the numbers, but this is almost exactly like one of our cost segregation study providers would have. This is the exact format that they use. I stole their colors and everything. But I've got fake data in here, so I'm not sharing client information. So this is the results of our cost segregation study. You can see right here, the very first line with numbers, that's that same $360,000 that we told them. We oftentimes find that our cost segregation study providers don't want to take on the liability of saying, this is what is land, this is what is building. They just want to say, okay, you tell me how much of your purchase is land, and then they'll go through and they'll allocate everything else out for you. And so that's exactly what they've done. They've gone through this study and they've found that 5% of the property that we purchased is personal property. That's going to be refrigerators, mortgages, I'm sorry, refrigerators, dishwashers, any sort of other equipment that would fall into that 5-year category. Land improvements, 15%. That's pretty standard. Again, parking lots, sidewalks, street lamps, anything to that effect. Landscaping would fall into that if it's extensive. And then everything else is going to continue to live here in our building costs, which is the 27.5-year property. And then you can see they've conveniently given us this total. So we can see it ties out exactly to that $1 million that we had for the contract price of this building. So with that in mind, again, let's go to our journal entry. So again, here on the same date, it's still on January 25th. What we're going to do is we're going to say our improvements and our building equipment. Improvements here, building equipment here. Those are the numbers, just like that. And so that's what we do. We just record them. And then the offset, we're going to be reducing the value of our building because we're moving this portion of the building cost into 2 other accounts. So you're not going to see this $511,000. That number is not going to show up anywhere. But at the end, after we've recorded this, if you go to your balance sheet, these 4 numbers are going to be the numbers that show up on your balance sheet for this asset. So that's the check figure. We record the cost segregation study, and then we hold this up to the balance sheet at the end, and we should see $360,000 on the land, $32,000 on the personal property, $96,000 on the land improvements, and then $512,000 on the building costs. Again, those are all rounded numbers. And then the total of our fixed assets should come out to this $1 million by the time that cost segregation study is recorded. All right. Cost segregation's super simple. It's just one extra step. The harder part here was section number 1, where we went through and we recorded the asset originally. Once you get to this point, it's really just harder to find this report, this page in the report from the cost segregation company, than it is to actually record the journal entry. Um, Got a question. What is an example of a land improvement? That would be, kind of a little bit self-descriptive land improvement. If you had to go through and flatten a lot in order to build a property, that would be a land improvement, preparing the land. If you had to put in utilities, if you had to cut a trench to put in plumbing, or if you had to put in electrical underground, those would be land improvements. Most commonly, what we see as a land improvement is sidewalks or parking lots or street lamps, anything that's outside of the building is typically a land improvement. There are some, caveats that, a pergola or a gazebo or something may not fall into that. Anything that's on the ground outside the building is typically a land improvement, and that's all going to be a 15-year asset. Um, Important call out on that. Those are all eligible for bonus depreciation. So again, we want as much value attributed to those assets as possible. Um, Bonus depreciation is a completely separate subject. We've got a lot of um, a lot of literature that's come out of Hall CPA in the last several years about bonus depreciation. But basically, it's just extra depreciation that you can take on top of the normal amount of depreciation. Um, I have a question. Can you pick up from the seller their cost segregation report that they had commissioned, or do you have to do a new one of your own? um, Given the values and conditions of the asset. That's probably going to be more of a question about the timing. If the seller had a cost segregation study done immediately before you purchased, within 30 to 60 days, maybe, then you can use their cost segregation report. Realistically, they're not going to have uh, a more recent one because they're um, more looking to sell the asset than to get the actual valuation and cost segregation. They're more likely to have an appraisal. Um, Patricia just informed me that I was missing a couple questions, so I'm going to pause here for a second. I'm going to answer one or two more of these, and then I'll answer the rest after we get to this next section. It'll be pretty short. What if you receive an asset through divorce and you don't have the original paperwork? That is a good question. So when you get it through divorce, you're going to have the original basis. So it's really more important that you find a way to get that original cost. There's a series of channels that you can go through to get that. Again, I would encourage you to reach out specifically after the end of this call. Schedule with me. We can talk in specifics on that. Um, Any reason you deviate from the formula in allocating the percentage of the purchase price to land? Um, the only deviations that I would recommend would be, again, if you have the appraisal, you would use that. Otherwise, I'd say um, use that allocation from the assessor's website. Um, Okay, typical cost of a segregation report on a single family home. So if you're looking at a single family home, I would recommend um, potentially doing the DIY option. You can do that for about $500. A cost segregation report can range anywhere from $2,000 to $5,000. If you get them on the expensive side, you might see upwards of 10, but that'd be a very large multifamily building. If you have somebody come out and do it for you, it's usually going to be between $2,000 and $5,000. You're probably not going to get a whole lot of value from that on a single family home. Um, does this process change at all if we do not form a separate entity? So from a quality accounting standpoint, I would recommend that you always have your own separate set of books and that you track everything as if it is a separate entity. Um, Now, when it comes to the tax return, it's reporting on your personal taxes. They're not going to report a balance sheet for you on your tax return. But for your record keeping and for knowing what your gain is going to be whenever you sell the property at some point down the road, it's a really good idea just to have your ducks in a row and have your accounting taken care of um, in advance and not trying to do it at the end. So again, if you're not keeping your books in a comprehensive accounting system, that would be where the process would be different. because then we're just basically going off your tax return. But if we do have a comprehensive set of books at that point, then no, the process is always going to be the same. All right. With that in mind, there's a couple more questions that have been coming through. I'm going to save those here for just a couple minutes. We've got a Q&A session at the end, and we'll come right back to those. Okay, so part 3, recording a refinance. You've held this asset, you've had it for a bunch of years, and it's time to get your equity out. You're refinancing the property. So what are we looking at? I use the same numbers. Again, points are made up. But we're going to say $800,000. That's what we've got. Maybe we were paying interest only for the last 5 years. Who knows? So we've got the same thing here. We need to go through, we need to remove the old loan, and we need to record the new loan. Okay. So again, what's important? We've got the payoff of the existing loan. That's the $800,000. Again, we're going to skip the settlement charges for right this second because we're going to come back to that with the detail. And then we've got the balance of the new loan. So we held this for however long we held it. We had $800,000 of financing originally, and now we've got $1 million of financing. So we're going to record that new loan there at $1 million. And then the very bottom line, we've got how much cash do we get out of this deal? We're going to get $180,000 of cash back into our pocket. That's what's going to be deposited after the refinance. So let's get started with the journal entry. We've got the old mortgage coming off the books, $800,000. And we've got the new mortgage coming onto the books for $1 million. Sometimes what you may find is that this number, this $800,000, may not line up perfectly with the amount that it said on your last mortgage statement. There are usually about 3 ways that can happen. The first way is, maybe we didn't account for it appropriately in prior periods. So what we want to do is we want to go back to that last statement that we got from the bank, and we want to say, okay, well, what is the bank saying that our liability should be? And we want to match that to our books on the same day. So if it's December 31st of 2024 in this situation, we would look at our year-end statement, and it would say $790,000, but our books say $800,000. So something happened there, and we need to get it straightened up and lined up before we move into this process. If that's not the case, if your statement matches your books on the last statement date, then that's great. So the next thing we want to look at is, do we have an early payoff penalty? Is there anything that the bank is going to charge us extra fees in order to be able to get rid of that old loan? If that's the case, we're going to record those as loan costs, and we're going to move on as we just basically take the old amount off. If it's $790,000, we're going to take $790,000 in our example here. We'd have a debit of $790,000 to mortgages, and then we'd have $10,000 increased loan cost, and that's going to bring us to our $800,000 total. And then the last possibility is that our statements were right as of the date, and then when we do the payoff, and this is extremely common, we've got a little bit more that we have to pay because we have a couple days of interest that we have to pay at the bank. In that situation, we would take the $790,000 from the mortgage, and then the additional $10,000 in that situation would go to interest expense. Again, that's gotten into the weeds pretty far. For this simple example, all I'm doing is taking the $800,000 of mortgage off the books, but I wanted to make sure you're aware as you go to apply this information, sometimes it doesn't line up so cleanly. Again, those 3 reasons that it could be off, maybe the books weren't right. That's number 1. Number 2 would be potentially an early payment penalty or other penalties from the bank. And number 3 would be that we need to record interest. Again, great note to take if you're following along at home. Okay, so we've got old mortgage coming off for $800,000, new mortgage coming onto the books for $1 million, and then the cash for $180,000. Again, those are the numbers top to bottom that we've got here on page 1. So then let's go on to page 2, closing costs. So right here, we've got $5,000 of interest to be paid with the closing costs. This is interest for the new loan to cover the number of days before your next payment. This will be different from the payoff. Sometimes on this page, you will see a specific breakout of the payoff that shows, here's what happened. This is loan, this is fees, this is interest of the payoff loan. That's not something that always shows up, and I'd say probably isn't even super common. Um, so we've got the $5,000 here is interest, and then everything else that we have here are more additional loan costs. So these title charges, as we were looking at acquiring the property, these were called closing costs, and they got rolled into the basis of the property. In this application, we're going to call them all loan costs because it's all of this is a cost that's in relation to acquiring new financing. So again, the only thing to call out here is the interest expense, and this is going to go directly onto your profit and loss, your income statement. Everything else is loan cost. So let's put those into our journal entry that we're working on here. Again, the old loan coming off, the new loan being added, the cash going into our bank, the interest being paid of $5,000, and then the loan costs. And I've got it cut off here at the bottom of the screen, but you'll see that these two balance, the debits and credits, are exactly the same. And that's it. So what we've done is we've covered how to record an initial acquisition. We've covered how to record a cost segregation study. And then finally, we went in here and we recorded a refinance.